Bring in Bob Iaccino of Path Trading Partners, joining us live from the CME in Chicago. Bob, wonderful to see you there. Thanks so much for joining us. Now, take us through what you made of the session today, because I note on Friday we saw the S&P posting its 30th consecutive session within a 1% move on a closing basis there, and it really looks like it's been no different today. Very light trading volumes that have gone through once again. What did you make of the session, and I guess where the market's sitting at the moment more broadly?
Well, again, thanks for having me, Leanne. I appreciate it. One of the things that I was looking at today was the complete boredom from a volume perspective, from a movement perspective. What you watch with the equity markets is you look for relationships. And when the equity markets are just attaching to anything they can, for example, the fall in crude oil prices seem to put a cap on the energy sector, save for Exxon. Exxon was the only stock that seemed to be able to perform, at least in a sideways fashion, with energy getting hit so far. But Marathon Oil getting hit by over 7% just because crude oil was down 3%, which in the last week or so has not really been a dramatic move for crude oil. We saw crude oil up 30% less than a month. So a 3% move isn't really that much on a day-to-day basis with the volatility we've had. But with the low level of the VIX, the fear index for U.S. equities, I think this is the kind of movement you expect based on that lower volume. So all I've been looking at now is the structure of the Fed comments. Do those comments look any different from the months and months and months of prior comments we've had where they referred to events that were going to stop them from raising rates, but saying rates were still at rate hikes were still on the table? And I don't think they're any different at this point.
Now, the market really seems to be at a crossroads at the moment, given these high valuations, and we've really seen them struggling for direction in the past few weeks. A lot of that capped by concerns around earnings valuations, and then, of course, those mixed messages, as you say, from those Fed officials who clearly seem divided on when to move rates next. What do you think it's going to take? What's going to drive the next leg higher for equity markets?
Well, I don't think valuations are stretched. They're definitely on the high side of normal. But we've seen them in the low 20s and mid 20s for extended periods of time. So I think there's room for that to go. It really is a decision, in my opinion, this is strictly my opinion, of stable energy prices and a little bit of inflation forming on the consumer side. And we haven't seen that. You mentioned earnings. We saw very poor retail earnings, save for a couple of places like Walmart and actually Lululemon's coming out on the 1st. I expect them to do fairly well, and Dick's Sporting Goods did well, but pretty much everyone else did awful. And that shows some weakness in the consumer in terms of bricks and mortar. Online sales surged a bit, but didn't make up for that weakness. So it doesn't look like it's going to come from the consumer yet, so it needs to come from the Federal Reserve, and that should come in the form of a confident 25 basis point rate hike. I think that actually will help the market after the initial sell-off. But we don't have a history of rate hikes going into presidential elections. It just doesn't happen. I would argue, though, if I were sitting at that table, this is the best election in history to go ahead and hike rates beforehand, because I don't think the level of the stock market is what people are going to vote on in this particular insane election that we've got setting up.
Right now, though, the market doesn't believe that the Fed will hike rates, does it? Because we're seeing the dollar index remaining pretty weak, and then the euro continuing to strengthen. So that really is a suggestion that no one believes that they're going to be doing anything this year.
No, I would agree with that. I mean, the Fed doesn't have any credibility, has about as much credibility as OPEC does in discussions with Russia for a production cap. I don't think that's going to happen either. But if I were sitting there talking to the Fed members, which, quite frankly, they don't take my calls, Leanne, but if I was, I would tell them that you have the opportunity to do it. The data has gone in the direction you want it to go in. Jobs have been relatively strong if you don't compare it to past recession. We do have growth, although we don't have screaming growth. And I think the confidence that the economy is going to sustain without the Fed having the confidence to hike rates just isn't going to be there. Earnings, like you mentioned, almost done with them, basically just good enough to keep the stock market moving sideways and not collapsing. So I think it has to come from the Fed.
All right, well, speaking of the Fed, obviously seeing a lot of these split opinions all over the place at the moment. I mean, half are worried about employment and too low inflation pressures building and so forth, whilst others are the opposite. So markets are really looking for Janet Yellen to come down with a clearer verdict this week at Jackson Hole. Do you think, though, that markets could be disappointed?
I think they could. I think when she was put in the chairman's seat, I think everyone understood this was going to be a more dovish Fed, especially given the circumstances. She's known throughout her career to accept a little bit of inflation, at least in some of the papers she's written and some of the speeches she's given. She would accept a little bit of inflation in exchange for more people being put to work. And in theory, I don't disagree with that. But I think with the situation we're in now is we're not seeing inflation, in my opinion. We're seeing asset inflation, but even that's tapering off. Equity markets have doubled since the crisis. Housing markets have gained strength and the prices have increased, but mostly on the higher end. So we're seeing this kind of stagnate. And that's because the lower to middle class has not grown. Jobs have not been created in that area. And our job participation numbers aren't decreasing. Rather, the labor pool numbers aren't decreasing at the rate we'd like to see. And I don't think the Fed can do much more. So if they're worried about inflation, well, they really can't cut to prevent any of that getting any hotter. So in a counterintuitive measure, I think that hiking rates would actually help.
Up until now, though, Bob, I mean, the Fed has found any excuse not to raise rates, right? I mean, it's almost like they're out of excuses because, I mean, Brexit didn't stop them, didn't stop the world from spinning. Do you think it could come down to the election? Do you think that could be a factor in the road?
Well, Leanne, that's a great way to put it. They've run out of excuses in the election. While maybe behind closed doors, that could be a quote-unquote excuse, they cannot come out and say, we've decided to wait to see what would happen with the presidential election. It was just essentially de facto what they said when they talked about overseas concern prior to the Brexit vote, right? Everybody knew they were pointing to the Brexit vote. And honestly, that seemed to be a good play, considering that it didn't go the way all the polls and the punters were thinking it would. So depending on how you phrase that. I mean, do they say political turmoil in the U.S.? That would be a very credibility damaging statement to make. So I think you're right. When you say they're out of excuses, they really are. They have to point to the economy. And if they point to the economy as the reason why they're not doing it, I mean, does that help stocks? I don't know that it does.